Okay, so if you're not familiar with us, and I know there's a lot of people on here that are business benefits consultants, we are a consulting firm that quarterbacks and puts everything together for these high deductible tax mitigation strategies in the defined benefit and tax strategy space. So if you're an advisor on here and you do assets, this is great. This is what you can do in the advisory side if you're a CPA, EA, somebody who's doing tax work. I'm going to I always start my presentations with how important it is to move into that advisory role. These are two strategies that get you to do that. So two questions just to think about to start. Start this with every presentation for anyone that's doing tax work. What if your most profitable clients came to you because of tax strategy, not just tax prep? So most of the people in our network that work with us and partners that have sent us cases that we work with and that are doing tax strategy, they're moving toward or they're already running that tax advisory model with clients that are paying them for ROI or paying a annual or quarterly retainer to be that type of advisor. So it's moving away from the commoditized version of tax. What is the lifetime value of one high income client who actually wants to talk about tax strategies year round? These are not things that hey, I put you in here and I've changed your your tax election and you save some money and we don't need to talk again until next year. The benefit to these is it gets you to have a higher level of communication with clients. Two very different strategies. We have the same goal here. Defined benefit and cash balance plan, restricted property trust. Again, I'm going to talk on the first, and Winston will come in on RPT. But these are being done to reduce your tax liability and allows you to put away money for the future, whether it's in a retirement plan or some type of asset. It's getting money put away outside the business to be moving money outside the business on a pre-tax basis and get a deduction. That's generally the main goal of it. Secondarily, maybe somebody is behind in retirement and needs to catch up. There's limits on these savings plans. We work with many different actuaries. I pulled some of these the recent numbers from a recent one, from one that we often look at and use. And just to show you from a simple IRA and SEP IRA, which is what a lot of people are used to on the smaller business side, moving into a 401, then you start layering some of these other things and get much bigger deductions. When I show this slide, I always explain DB plus 401k is not a $269,000 limit there. So every design is different, and that's the main thing that I try to hone into people when I give these presentations. Is every TPA is different, every actuary is different. So that number 269 in this specific case could be a number of $500,000, $700,000 from a different design. It's not based on when you get into the on the shelf or traditional retirement plans such as 401, SEP, and Simple. That's where you have your set limits. I'm going to put both of these under the tax strategy list. We all know that list can be hundreds of things, and it just keeps growing and growing, and we continue to see all different strategies come out there. Winston's going to talk about the credibility on restricted property trusts and why it's gotten way more credible over the years. On the defined benefit plan side, this is a retirement plan. This has always been credible. It just has to be ran the right way with the right people, and it needs to have a constant contact to make it successful because these businesses change every year. Their cash flow changes, their goals change, their employees change. So we're going to put these on the tax strategy side always and move them away from the retirement planning side, just because when you are saving that much in taxes, it's a disservice to not call them an actual strategy. We'll talk about what could be accomplished on both of these plans. We're looking for business owners that are paying taxes on income that they would rather put away for themselves. That's generally some type of pass-through income or profits from the business. They're spending more than they need to on business expenses at the end of the year, maybe buying trucks and certain machinery, or spending whatever they can to try to get increased expenses, just showing that they have profit in their business and they need to put money away into something. That's going to be a good fit. They have a retirement plan that they're often funding. They're not getting a large enough benefit. So you see 401ks, there's generally a profit sharing component to that. That profit sharing component, when you go to do a calculation, that's standing alone with the 401, you often see the employees getting more than the owners. So when you add on and you really start looking at these combination plans, which is where we specialize in looking at and finding the right designs, what we're trying to do is maximize an owner's benefit. So an owner is getting anywhere between 90% to 100% of a plan. Sometimes that's in the 80s, but either way, we're talking about an owner's enhanced benefit plan. We're not generally talking about a plan to take care of employees. That's where a 401k can be used. And a great prospective client is going to be someone that you have that's comfortable with the amount of income they're already taking out of the business, and they really want to ramp up their retirement, and they're willing to put away at least $100,000 a year to save on taxes. There's flexibility in different ways on both of these, and that's to be discussed and go through. My probably most important slide that I try to teach people is that every plan and every design is different from the next when it comes to DB and cash balance. They are not the same. And that's not just initially, that's every year, because we're dealing with a plan right now that does not have flexibility, that we inherited through something. And this plan doesn't have flexibility. We're doing everything we can to try to make it flexible for some of the changes that have occurred in the business. But if it was a plan that we started or we've been working with, there's tons of ways that we can change ranges, do amendments, freeze, thaw, do all these different things for flexibility. Initially, based on a census, we want to figure out again how we can get the owner, partners, or taxpayer the highest percentage of benefit inside these plans. Again, we can do amendments, change funding ranges, freeze, adjust W-2s. And this is why you have to be fully involved in these plans, not just working with us, but having the client involved, and it has to be something that occurs throughout the year rather than one time. We're going to set up a plan and look to see what that target number is at the end of the year. We don't want to do that. We want to get ahead of things. We want to create a predictive type of plan. Want to give a quick case study. This is one at 91%. I like to use this a lot because they have a lot of other things going on, this husband and wife. He is a CEO of a company, gets a W-2 at that company, but there's consulting income and there's other income on the side that's significant. Pam has a medical office and she already has a 401k. There's some employees there. So they do have this corporation together, and that's really where we're holding the plan. They are in their mid-40s, and we were able to obtain a $500,000 deductible contribution, 90% to them. So I will caveat to that probably this plan's probably 4 or 5 years old, and over this time frame, I think that 91% is higher. And I say that because Pam has had some turnover in her business. And so some people that we've had to give some benefits to, or that get assigned those benefits, they have invested. So that money is coming back and is held to the owners. Solos are great. We love solos. Putting away $100,000, putting away $200,000 or $300,000 from somebody. In this case, Howard is a W-2 for a company similar to the previous, except he gets 1099s from many other companies and wants to really put away and max out those 1099s that he has. So we looked at all different designs to do this to get to a certain number. Again, this is a solo DB. It's simple, it's easy. We didn't have to use a 401. We didn't want more money in the plan. This totally fit, and we love to do this because it's a lot easier. This triggers a lot of taxes that you're going to save on. We all know about QBI and the ability to get to a certain level. Here we're reducing income to do so. Just want to go back. I like to show this chart, not because of the specific case, but because these numbers are a little bit older, actually. It's more to show that these are $100,000 tax savings and up. So it doesn't mean that the 48-year-old is putting in 66,000 and has that cash balance number and equaling a total of that. We've done these plans at much higher levels. So we always say the rule of thumb is if you could put away $150,000 a year or more, you're a good fit for this type of plan. But from a tax saving standpoint, that number could get very large. Here, we're showing a 45% only because we have California. A lot of people ask me, where does this get deducted? So stuck in this slide for you to take a look at. I don't want to get too much into the detail. It's really to show that when you have a 401k, that's coming off of a W-2. It's an employee contribution. It's defined contribution, same as profit sharing, but defined benefit or employer funded dollars are going on in a different area. Again, showing that you have very specific knowledge in a lesser known vehicle, lesser known tool, strategy. This attracts higher income, higher net worth business owners to anyone that you're working with. Wall Street Journal just did this, and I love how they actually recognized it. Retirement savings weapon doctors and lawyers use to build wealth. I can tell you that most of the cases we get currently are not doctors and lawyers. This used to be very popular in the medical space, primarily because of the consistent income. We see every industry for this now. Wanted to highlight a few points here. People save the most in cash balance plans are typically business owners, pay to share the profits, and they want to save more than the 401. That's exactly where this comes in. If you getting closer or have hit that 401 limit, that's really where you're looking at this. Strategies, taxes you pay, taxes you could have paid. Again, that's tax planning, and that's your job as a tax advisor to what you do. So we want you to take a look at this strategy, connect with us. Let's take a look at different designs, and we want to be able to show you that value. So we also do on our website a very simple, easy request for a proposal where we're asking a lot of questions about the business, but they're meant and designed to get filled out by the tax advisor rather than the client. So you can get something or some kind of work product back from us that shows how this strategy works, and then we can tweak it and work with you on it. Our contact information is here. What we're going to be doing is sending an email out anyway with this. So if you are unable to capture it or want to book something, we do have our QR code there. You can book immediately if you wanted to. And then, like I said, we'll send this back out and do a follow-up with everybody. Wanted to keep this kind of basic, show the benefits to it, the power of it, but not take too much time on the technical aspect of it, so we can leave some room for the restricted property trust. So Winston, you can take it from here.
Okay, David, thank you. My name is Winston Way. I'm the founder of Complex Capital. We work with many CPA firms and advisors, so some complex tax strategies similar to what David does. But I just want to take a minute to talk about David and his firm. I worked with David, as you mentioned earlier, many years. I had worked with many actuary firms directly or TPA firms. I have not found one that's objective, as professional as David's firm in terms of finding the right fit, customizing, doing the right discovery for the client, and the flexibility. We have recent couple of nice cases where the client needs huge deduction, and they wanted something strictly for themselves. David's firm was able to address that very nicely, and the client's very happy. So my platform is a real complement to the pension area that David does. It's called Restricted Property Trusts, and I'm not sure how many people in the audience are familiar with it. It's been available for 25 years, so it's nothing new. The reason the many CPAs that we meet, new meetings, they have not heard it, they heard very briefly of it because it's not mass marketed. It's strictly selective advisors across the country that Ken Crabb, the founder, decided to select to work with him to provide to the clients. It's fully selective, unlike a qualified plan in terms of comparison. So if you have a company that has thousands of employees, David can run his numbers to see if it makes sense for the owners of the company. If it does, we can put this on top of that. If it doesn't, then this will be a standalone. Same tax deductible contribution, asset protected, fixed rate of return. I'll expand on more. Can be designed for estate and business protection. Next, please. It's a vehicle. One page too fast. Right there, yeah. It's a vehicle for successful business owners that want to mitigate taxes as the pension plan. It's tax deferred, tax advantage distribution. It's the one difference here, and I'll show you an example. At the retirement, you can complement where the qualified plan and IRA's 401k pension would be taxable. This will allow a tax-free distribution similar to Roth. So it'll be a good balance for a client for retirement planning purpose. Next, please. It's employer sponsored plan. It could be done strictly for the owner or the key executive. Actually, I had a Zoom call yesterday with a referral from a CPA. They have about 80 employees in the company, and it's family owned, generation transfer. The son and the daughter is running the company now. They're looking to do a plan that benefit the owners, okay, and then they want to do well, 10 key executives to be added into the plan in 2026 because they have a incentive program that allows them to get bonuses. They'd rather not put bonuses and put into this plan. So we're getting the census from them this week to run some customized design. Here's the actual case, recent case that was just approved 2 weeks ago. This client has a maximum defined benefit plan that was done by another firm. And this is one of the case I'm going to bring it to David once my plan is done. The reason is when the clients send me the information, the firm, his plan, only 76% benefit him and his wife. It's a doctor's practice with about 40 employees. So it's not cost effective, but I didn't want to say anything to the client at that point. But I'm going to have David's firm review it, see if we can bump up the ownership percentage to a higher amount. So this particular client decided to put in 250,000 for himself. He also put in 100 for his wife for the restricted property trust. It's a 5-year plan on this design. Initially, it will give this client $9 million life insurance. It's age 44. It will go to about 12 million because it's under a whole life policy and explained that it has to have guarantees. At year 11, the client decided he wants to get out of the plan. Then the plan becomes a reduced paid up. The policy becomes reduced paid up. It will go down to 4.6 million. But the last bullet point, retirement, he's going to get about 229,000 a year, income tax free for 20 years, from 62 to 81, for about 4.5 million. If this client's still alive at age 100, there's still a little bit left of cash value and death benefit. And the death benefit are tax-free distribution to beneficiaries. So in this particular case, because he's in the 50% tax bracket, he's a New Yorker. You got New York City federal and state tax. He's going to save about 842,000 income tax over a 10-year period from the time he put this in. Next page. Its annual contribution fully deductible like a qualified plan, as a grow tax deferred, same thing as a qualified plan. Next, please. The entities that qualify for this are C Corp, S Corp, LLC, partnership, but no sole proprietorship, okay? Next, please. The constructive receipt of the property of control of the asset. There are no current tax deduction. It's called substantial risk forfeiture. Here are the advantages. As I mentioned earlier, it's fully selective, asset protected. And if it's a younger client, they don't have to wait till 59 and a half to take money out versus a qualified plan for liquidity if it's needed. Disadvantages, there is a minimum 5-year commitment. Contribution has low flexibility. There's no loans available. It's designed intentionally with IRS 25 years ago to make sure it's a plan that's not going to have real issue with IRS. If there's a default for whatever reason, there's a name 501c charity that the client name as a default in case they could not fund the plan during the 5 years. As I mentioned, over 1,000 plants across the country. Currently, there's only one company that's doing this with Ken Crab. It's Penn Mutual. But we expect by end of this year, there'll be another company added, Mass Mutual, because of capacity purpose. 4 or 5 major public companies are going to be adding restricted property trust as deferred compensation, which is better than the previous plans that they may have. So we'll have at least 2 major companies going forward. Give me a couple of case study before the Q&A, David. One is, as I mentioned, the one case study was on the doctor. Last year, I had a dentist that had a maximum defined benefit. He still needed deduction. The CPA recommend RPT, so he put in 200,000 last year on top of the defined benefit. And another dentist put in enough 150 RPT on top of his defined benefit. And one business owner, unlike a medical healthcare practice, he had a 450,000 defined benefit, but his revenue continued to grow. So he put in 300,000 RPT in 2023. He put in another 100,000 last year, and most likely he's going to add in 100,000 in 25. Okay, so it gives you flexibility to add additional RPT to the existing trust. So I'm done, David. So we can either have Q&A or we can.
No, that's great. Like I said, I know a lot of this was a big overview and going through things.
Right.
Just to touch on some stuff that Winston said, because I know there's questions on this. When I went through defined benefit and cash balance plan, we're not talking about solutions, investments, insurance, any of that stuff. You can put, and we just did an alternative presentation on how to put real alternatives inside DB plans, including crypto, real estate, private equity, private credit, all these other things that are out there and where they should go. So in defined benefit, cash balance, you really could do anything that you want. You do want to be more on the moderate side. With Winston's strategy in restricted property trusts, that has to, by law, based on combining a few tax codes, has to go into a very specific type of insurance product. And some people love insurance, some people hate it. This is not like qualified insurance. This is not like regular insurance, like a LERP type strategy that might be out there. This is totally different. Restricted property trust is a actual strategy that has to be done through a specific outlet. And Winston spoke a few times about Ken Crab, who I believe is an attorney that created this and continues to contest it and keeps winning against the IRS. Is that right, Winston?
Yes. So if you want, I can give you a minute to expand, and we can provide you all the detailed caseload. For the first 16 years, there's been random audits by IRS with no changes. And in 2016, a whistleblower went to IRS and said, restricted property trust, no good. So Ken Crab said, no, this person is accurate. So he fought IRS from 2016 to 22. They random audit 3 or 4 plans. In 22, IRS appeals and Supreme Court judges unanimously said IRS was wrong. So that's very rarely happens. So because of those 2 decisions, corporate companies decide to pursue through the compliance about adding RPT for executive deferred compensation. So going forward, to me, it's good news. I hate to show a non-qualified
You froze.
challenge. Iris has put a white flag array on this. So for future clients, you're going to be very safe on this.
Yeah, and also another distinction between the two things is defined benefit, where we're looking to get, we really need to look and test everybody and look at, maybe an owner gets anywhere between 90 and 98% if there's employees, sometimes higher, sometimes lower. RPT is going to be something that's specific to who you want to cover. And it's going to have its own limits, because you can't go and put in $1 million into an RPT plan. It has to match up with certain things on what you're allowed in death benefit and other things. So there is structure around it. Winston, correct me if I'm wrong, but I don't believe you need any TPA or administration for it.
Trust that has a separate EIN number. It's not a revocable life insurance trust, a different trust that's designed for this purpose.
Right. So it's held in a trust. It's held in a very specific type of trust. That trust has to adhere to certain areas of what could be done. Sometimes a solo plan or a business that does not look good on our census. So, for example, if the owner has employees that are certain ages, or if you've looked at certain cash balance DB plans with multiple designs and you've come to the conclusion that the owner's not going to get enough, meaning maybe they're getting 75, 78%, 82%. They don't want to give up that additional amount. Well, RPT is a secondary great option there, because they can then go and get pick and choose who they want, similar to a deferred comp type of plan or a non-qualified type of plan, cover who you want. It just has to be done in a very specific way. There are a select group of advisors that do that. Winston is one of them. So that's why we wanted to bring him on. I don't see anything in the Q&A, any questions in there. Somebody did ask if we are a TPA. No, we are not a TPA, and that right now that is on purpose, because we like to use all different designs. As I mentioned before, one is not the same from the next. And we can show that in all different examples. In fact, we got a case back today that went out to quite a few different TPAs, and the difference in what the owner can put away and how much they're getting is drastic. It is drastic. And most of the time, people don't have that opportunity to go and look to find what's the best design that's out there and go and do due diligence on all different ways on how to find what's best for the client. So they don't know. They might look at it and say, oh, well, I got, they're getting 80% and they can't put enough away, and this just doesn't work and fit what they're trying to do. Not knowing that, yes, there is another design out there where they can get exactly what they want. So again, keep both of these in mind. We're going to send a follow-up email. Hopefully we can get some meetings booked to talk to you in more detail about certain clients and cases that you have. Another question that came up is, can cash balance plans always be combined with RPT, or are there things to prevent it? There's not anything to prevent it, except we need to know up front the total amount somebody wants to put away. That's really what, then the two things can work together if needed. Sometimes RPT, you don't need it. You don't need a DB plan because you're not putting in enough. You just don't have the cash flow, or you're not that type of business that needs to defer. Or you're using RPT because you want to cover a specific person only, where cash balance plans, you're really looking for a super high number. If you're maxing that out and want to layer this on, you can absolutely put a non-qualified on top of a qualified to make it fit. So Winston, somebody else had asked, Penn Mutual won't underwrite a client, or Mass Mutual. Can RPT work with in-force life insurance? That's a great question. If you have an
Great
in-force
question.
policy,
Unfortunately, no, has to be a brand new structure set up, cannot be an existing policy. And just to also let you know from underwriting standpoint, I had maybe 20% of my clients that's their main goal is tax deduction. And they're borderline, they're not super healthy, but they were able to get up to table D because the deduction's the same amount, it's just the face amount's lower. So if you have a client that do need a tax deduction, whether it's David's platform or combined or RPT, and it's borderline health, we can still give it a shot because we have good favorable underwriting relationship with Penn Mutual.
it's great. I think that answers the questions.
One more, I think.
We're gonna keep getting a few more coming in.
Yeah.
What's unique about Penn Mutual versus another carrier? Is the whole life the only option? Why not an
Yeah.
IUL? That's a great
Okay,
question because I know
great
you're a fan
question.
of that. Yeah.
Yeah, great question. Uh, the way this plan was set up, it has to have guarantees. Okay, and whether it's term insurance, VUL, IUL, do not have the guarantees. And there are currently 4 or 5 major solid mutual company whole life in the marketplace. Everyone in the room knows the names. But in the last 10 years, Penn Mutual has been one of the most competitive in terms of cost expense within the whole life policies because I've ran against some of the other companies just comparing whole life to whole life. And Penn is still more benefit for the client in that benefit and cash value growth.
Okay, so a whole life, and again, I don't want to get, speak on insurance
Right,
or investments, but I just to ask, so whole life has all the guarantees, and it goes through the structure that
right,
restricted property trust is
right.
approved for. Is that correct?
Yes,
Okay.
yes.
And does that product come down to how the IRS has approved this?
Yeah, I think 25 years ago, before RPT was created, there was Viva Plan 419 where it was very abusive from the consumer and advisor mass marketing in it. So Ken Crab decided when I file for this plan, I'm gonna have a couple of things. I'm gonna have to default if it's a charity. I'm gonna have a 5-year commitment. It has to have guarantees. So I think because of that, the IRS approved a first plan that was a $15 million deduction many, many years ago. That's how RPT was born. Intentionally, it was done that way.
And Winston, are there any minimums?
Minimum's 50,000. As David mentioned, this doctor that was approved that has a defined benefit, he was approved for 1 million. He decided to start off with 350 because he didn't want to commit cash flow wise. But it's based on net income of the business as well as the insured's age, the owner.
Okay. And someone had asked, can RPT be rolled into another strategy or used in conjunction with premium finance or a hybrid?
Okay, great question again. So I have many clients that's rolling out the RPT now, and so the plan once it's done, the policy is still growing because it's a mutual company whole life. They can either collateralize the cash value into premium financing, right? Or they can use the as a down payment towards the funding of the premium financing. So we've done a few of those strategies already.
Okay. And just to add to that, I've known Winston for a long time and he specializes in these complex things. So he's done a lot on the premium finance side and some things outside RPT, although that is his specialty. Definitely try to get with him and spend some time because when it does come to these different types of insurance designs and structures that are all out there, he's had a ton of experience in that area. Um, I think that answers all the questions that we had. These are very good questions. We will send out a follow-up with some bullet points, our contact information, and scheduling links. So happy to talk to anybody that has questions. And Winston, appreciate your time and everyone that was on
Thank
today.
you, David. Thank you, everybody, for joining.
Thank you.
Stay cool if you're in the East Coast. Thank you.